Good morning or afternoon or evening, depending on where you are in the world. This is Jeffrey Christian from CPM Group. Welcome to our 2020 Platinum Group Metals Yearbook launch. This is the 34th year that we have published a Platinum Group Metals Yearbook or survey as CPM Group. The reports themselves actually go back to 1981 when we were at J. Aron before its merger into Goldman Sachs. In May of 1981, we published what a lot of people see as the first Platinum Group Metals market report that was there. A lot of the research was stuff that I had actually begun in the 1970s. So we've been following the PGM markets since the 1970s, and we have a pretty consistent long piece of data, some of which you'll see in today's presentation. I will start by talking a little bit about the price action that we've seen in platinum, palladium, and rhodium this year, and some of the issues related to inventory changes that we've seen in platinum and palladium. After that, I'll pass the presentation over to Rohit Sabin, our Vice President and Director of Research and the main author of this year's Platinum Group Metals Yearbook again, who will run through in greater details platinum, palladium, and rhodium. And then he'll kick it back to me for a very little bit of commentary on ruthenium, iridium, and osmium. We'll open it up for questions. On your webinar panel, there is a place where you can write questions, and during the question and answer period, we can read the questions and then respond to them accordingly. We're giving ourselves plenty of time because there's a tremendous amount of space to cover. First thing I wanted to do is thank this year's sponsors. Most of the sponsors are companies that have been sponsors of CPM Group's yearbook, PGM yearbook for many, many years. We have a new sponsor, Grid Metals Corp, which is actually the successor of Mustang Minerals, which is a company we worked with in the late 1990s, early aughties. We're glad to have them back. Exploration company in Canada. We have Group 10 Metals, which is another exploration company in Canada. It has some interesting properties in the Yukon, but much more interesting these days are some properties it has adjacent to the Stillwater properties in Montana. Kitco Metals, obviously everyone knows. Noah Capital Markets is an institutional broker that we've worked with in South Africa since its inception in 2004. Umicore, one of the major producers, refiners, and fabricators of PGMs and other metals in the world. The Institute of Scrap Recycling Industries, which represents the scrap recycling industry. Sabin Metals, again, another scrap recycler and major refiner of PGMs, as well as gold and silver, and Monex Precious Metals, which is a major retailer of precious metals investments in the United States. We also have our three Chinese partners, the China Gold Association, China National Gold Group, and Jingyi Gold. These are companies that have been our partners in translating and distributing our gold and platinum yearbooks in China for many years now, and continue to be doing that, and are looking for other ways to work with CPM Group should the US government allow it. So again, I will talk about PGM prices and inventories. And if you look at the platinum price, you can see that the price used to trade $1,400 to $1,800, 2010, 2012, 2013. It broke below $1,400 when the strike settled in South Africa in the middle of 2014 and fell steadily down to a low of about $800. It's a little bit of a dead cat bounce in early 2016, but for most of the time since 2016, the platinum price has been trading between $800, $850, $900. It was trading $850, $900 in 2017, early 2018. It fell into a lower range of $800 to $850, late 2018 through 2019. It started to rise out of that really at the end of last year. the final half of 2019. We got back up to $1,000 and a little bit over $1,000 earlier this year. When the coronavirus pandemic led to an economic shutdown globally in March, we saw the platinum price fall along with palladium, gold, stocks, and everything except the US dollar. That plunge took it down below $600 briefly on an intraday basis in mid-March. We came back up and we've basically been trading between 800 and 850, 875 ever since that time. Our expectation is that the price will continue to trade in this range for a while. We do see scope for higher platinum prices in the future, but frankly, it could be a couple of years from now before we see that. As I said, we've been doing data and research on PGM markets since the late 1970s. And we're very proud of our heritage in this market. At that time, South African producers did not even reveal how much platinum, palladium, and rhodium they were producing. CPM Group had to estimate that. A lot of the data was very secretive. I personally started doing this research in 1979, and we took the data back to 1976. We do have some data that predates 1976, but what we found was as we were going around the world talking to people about production, refined recovery from secondary scrap, fabrication demand, investment holdings, what we found was that people's memories would go back 2-3 years to 1976. It's funny because we've had people say to us, why is it that everyone's data in PGM starts in 1976? And the answer is because that's where we started when we started collecting this data and developing these estimates in 1978, 79, 1980. This data is important because of several things. And first off, I should say, you know, our data looks good, and it looks good compared to other people's data for a variety of reasons. We don't put things in our supply-demand balance that other people do that distorts the relationship between supply-demand, the supply-demand balance, and prices. We have other information that we plug into this. The data is supported by the fact that our projections for platinum, palladium, and rhodium prices have been pretty accurate since we started making them in the end of 1980. And those price projections are based on our fundamental analysis. If our fundamental analysis were severely flawed, our price projections wouldn't be as accurate as they have been over the last 40 some odd years. So that gives us a little bit of confidence that what we're looking at is good. There are other things that give us confidence. When we published that first report in 1981, what was then Rustenburg Platinum Mines is now Anglo Platinum Mines, Impala Platinum Mines, and the Soviet government all launched internal investigations to see who had leaked this information. As I said, it was all corporate secrets in South African platinum mining industry at the time, and the Soviet Union had all of the platinum information as state secrets. And the fact that those three authoritarian regimes, if you will, launched investigations to see where we had gotten our data and if somebody had leaked the data to us was the only confirmation we had that our estimates were accurate. We saw similar situations in the late 80s before the Soviet Union collapsed. We saw similar situations in the 90s and in the aughties. And there have been various times when we see information, both because of our work with the auto industry, with electronics companies, with producers and refiners and mints, we see information that helps support and the accuracy of our statistics. Now, that gives us some confidence in these statistics. And then you can say, what do you look at these statistics? You will see that in the late 1970s, when we were first putting together our estimates of supply and demand, we estimated that there was 4 or 5 million ounces of platinum that were held in refined form above the ground. And frankly, most of that was held by the Soviet government at the time, according to our estimates. And again, our estimates were supported by the fact that there were certain investigations to see where we were getting our estimates from. Over time, we've had supply and demand estimates on an annual basis going forward. And Rohit will talk in detail about those estimates in recent years. But what that gives us is a cumulative surplus and deficit that we can say to ourselves, okay, there's a certain amount of metal that's being refined in excess of fabrication demand or less than fabrication demand. And in those years when there's more being refined, that metal goes into inventories. Some of those inventories are unreported investor stocks. Some of those are Soviet and then Russian government inventories. Some of them are industry inventories. Since ETFs came along, we've actually had reported ETF holdings, so government inventories, and then there's reported exchange inventories, which are relatively small. And you can see from this chart that there were consistent growth in these inventories up until around 1998, 2000. We had a recession at that time and there was some reduction. But then investors got interested around 2001, 2002, and they started buying a tremendous amount of platinum. We know that for a few reasons. First off, we were working with some of those investors. They were high net worth individuals, hedge funds, hedge fund managers for their own accounts, people like that. And the second thing is we issued a buy recommendation in 2000, 2001, 2002 that we saw the price rising. And we were able to watch the investors buy a tremendous amount of platinum, about 5 million ounces, from 2002 into 2010, 2011. And that drove the price from $350, $450 an ounce in 2002 to about $2,000 an ounce, $1,800, $2,000 an ounce in 2011, 2012. After that, investors took a little bit of profits. Then you had the strike in 2014, which reduced inventories held by the South African industry and PGM refineries. And since that time, you've seen inventories rebuilding to record levels. Now, some of those inventories are held by the industry, and some of those industries, very few of them, actually report how much is being held. You have some that goes into ETFs, and one of the interesting things that we saw in 2019 was a very sharp increase in ETF-held platinum inventories. We'll talk a little bit. And a lot of it still is held in estimated investor holdings. We started publishing this data around 2013, 2014, and there were a lot of people who were scoffing at it because, quite frankly, they had never seen this kind of data before, and it didn't exist in any other source. Now you have a lot of other people making a lot of estimates, and frankly, a lot of those estimates are quite cavalier because they're not necessarily plugged into the market intelligence that we've accumulated over the last 4 decades and continue to accumulate on an annual basis. But last year, we did see an increase in inventories, and a big part of that increase was in ETF holdings held by investors. Palladium, of course, has been in sharp contrast to the platinum industry, where the platinum price has been bumping along $800 to $900 for the last several years. Palladium has been consistently rising to ever higher levels. It was at record levels in 2011. It came down somewhat, moved sideways for a while, but since 2016, it's been moving consistently higher. It reached record levels in late 2017, and it has continued to reach record levels ever since that time. We have seen the big spike up at the beginning of this year, followed by the big spike down when the coronavirus and the economic lockdown began. And now the price has been trading really between $1,750 and $2,100, $2,150 over the last few months. Palladium prices have been record at levels. And I will leave it to Rohit to talk about some of the fundamental effects, some of the effects that these record prices are beginning to have on the fundamentals of the palladium market. But it is coming home to roost, and there are going to be some major structural changes there. Like contrast to platinum, we have an enormous amount of palladium that has been built up. Again, you can see we started with an estimate of about 11 million ounces in 1976. Much of that was held by the Soviet government at the time. But in addition to that, we had a couple million ounces of metal that were held by investors in Zurich that we were able to identify, even though they were extremely private people. And interestingly, some of those investors were still holding the metal a couple of years ago. And they were very happy because they had bought it $35, $45 an ounce. And when you can say, well, why don't you take your profits? The answer usually is, where would I put my money if I redeployed it from palladium? You want me to sell my winning investment and what? Put my money into investments that have not done as well? Doesn't make sense to me as an investor. Again, you see a lot of information that's not necessarily based on that kind of intelligence, but these are our figures. We have seen a plateauing in investment demand coinciding with the record prices, but it still stays very high. And then rhodium prices have gone parabolic. This is the third time on this chart, but in reality, the price of rhodium first spiked higher in 1979, 1980, when rhodium was first starting to be used in three-way catalyst converters in the United States, when you started having emissions for nitrous and nitric oxide emissions apply to passenger vehicles in the United States with the model year 1980. And you saw the rhodium price spike up, everything spiked up. Oil went up fourfold, copper went from 65 cents to $1.80, gold went from 200 to 850, silver went from 5 to 50, platinum went from 200 to 1,000, and rhodium rose to about $800. So we've seen 1, 2, 3, 4, this is our fifth spike. And I think this spike might be a little bit different from the others, because in all of those previous four spikes, you saw the price come back down because there was a lot of rhodium held in inventories. I don't have a rhodium chart for you on inventories the way I had for platinum and palladium, but our view, which Rohit will talk a little bit about when he gets to the rhodium section of his portion of the presentation, our view is that a lot of those inventories are gone because we've had persistent deficits in the rhodium market for most of the last 40 years. And you might actually see a situation where the rhodium is not available in above ground refined inventories to meet future demand. I'm going to pass the presentation over to Rohit now and let him talk much more specifically about some of the metals, platinum, palladium, and rhodium. And then we'll get back, wrap it up, and then open it up for questions. Thank you so far. Rhodium, Rohit, it's your turn.
Thank you, Jeff. So I'm going to start here by talking about platinum. Let's start here with platinum supply. So we saw total platinum supply, which is made up of mine production and scrap supply, rise marginally during 2019 to about 7.3 million ounces. And despite this being a relatively small increase of around 20,000 ounces in 2019, total supply was at its highest level since 2015. This increase that we saw in 2019 was driven primarily by mine production, with scrap supply declining during the year. Mine supply has now risen for its third consecutive year in 2019, but at about 6.1 million ounces in 2019, it was still lower than what it was in 2006, when it was at around 7 million ounces. So most of the decline over the past several years can be attributed to South Africa, but we've also been seeing declines in other major mining regions, the exception being Zimbabwe. We expect this decline in platinum mine supply to remain intact into the long term. And that's something I'll talk a little bit more about in the next few slides. And in terms of scrap supply, this is something that's already been in a declining trend for the past several years. So part of the reason for that decline has been lower metal prices, so lower platinum prices. But a more important reason has been the substitution and thrifting of platinum from autocatalysts over the past several decades. So a lot of the autocatalysts that are now coming into the market for scrappage contain smaller and smaller quantities of platinum. In 2020, we expect total supply to decline pretty sharply. We expect both mine production as well as scrap supply to decline. And this decline is based on the disruptions that we've seen resulting from the coronavirus. So there's already been a lot of supply loss due to government ordered mine shutdowns, voluntary mine shutdowns, refinery closures, and supply chain disruptions. CPM Group's expectation of total supply for 2020 is about 6.4 million ounces. And there is a great deal of uncertainty with regards to the forecast for mine supply as well as fabrication demand during 2020, just because of the uncertainty with regards to how the coronavirus would pan out over the second half of this year. We have handicapped our supply and fabrication demand numbers to some extent for potential further disruptions during the second half of the year. So, but there's still a great amount of uncertainty about how the final numbers will look like in 2020. So there's been a trend where we've been seeing South African producers increasingly focusing their mining activity on the UG2 ore and the flat reef ore versus the Merensky ore. And part of the reason for this is the sheer depletion of the Merensky reef. With years of mining, because of its more desirable low chrome composition, this ore is to a large extent already depleted. So if you look at the chart on the right-hand side, that shows you the reserves for South African mining companies at the end of 2019, and you can see how small the reserves from the Merensky reef are as of the end of last year. Another reason why you're seeing South African miners increase their focus on the UG2 reef and the flat reef is the higher proportion of palladium and rhodium in these ore bodies. So the typical split of the metal in these ores can be seen in the table on the bottom left-hand side. So you can see that the UG2 ore and the flat reef ore have considerably more amounts of palladium and rhodium than the Merensky ore body. The composition of these ore bodies has made them more desirable in recent years because of the sharp run-up in prices of palladium and rhodium. So if you look at the chart on the top left-hand side, this shows you the basket price received from each reef. And as we can see, there's an increase since 2016 in the basket price received from the UG2 and the flat reef ore, which has to do with that sharp increase in palladium and rhodium prices. The longer-term consequence of these developments, in our opinion, is going to be an ongoing decline in platinum production from South Africa. Another important factor for platinum mine production and PGM mine production in general, but platinum and rhodium mine production in particular, is the weakness in the rand. So in 2019, the rand basket price of South African production was at record high levels. While the USD basket price was still around 15% lower than its 2000 peak, we had rand prices at record high levels and about 54% higher from where they were in 2008, as you can see on the chart in the left-hand side. Now the rand and the US dollar price really began to decouple around 2011 because of the ongoing weakness that we've been seeing in the South African rand, as well as the weakness in the US dollar denominated PGM prices. Between 2011 and 2016, all PGM prices were declining. Since then, the palladium price really took off, and that helps to explain the uptick in the USD basket price, which you can see in the right-hand side chart. The weakness in the South African rand versus the US dollar has been one of the factors that has sustained platinum production over the years despite weakness in platinum prices. While this has allowed mining companies to subsidize their rand-denominated costs, it is a double-edged sword for these mining companies because it has also resulted in more supply, platinum supply, than what the market really needs. So this has had the effect of depressing the dollar-denominated platinum price. So what we're looking at here is South African mining capex, and this declined in 2019 to about $1.18 billion, which was down from about $1.3 billion in 2018. And while it's down from 2018 levels, it was still at the highest level that was seen since 2012. Now, the gains in capex that we've been seeing over the past few years has to do with the ramping up of the Booysendal and the Styldrift mines. With those ramp-ups now complete, the capex there has declined. In 2019, Anglo's capex rose, but it was almost entirely stay-in-business capex with very little project capex. So such stay-in-business capex, we don't believe is going to be something that would help to sustain that long-term supply of platinum. Outside of South Africa, we've seen Sibanye-Stillwater has been spending on its US mines. Most of its spending, around 60% of it, has been going towards the Blitz project in the US, which could be something that would help to support PGM production, but it's less of platinum and more of lead. So with that, we move on to fabrication demand. And global fabrication demand declined in 2019 for the first time since 2014. Demand stood at about 7 million ounces in 2019, which was down around 2% from 2018 levels. Much of that decline, almost about 90% of it, can be attributed to declines in platinum jewelry demand. Platinum jewelry demand in 2019 stood at about 2.2 million ounces, which was down 6% from 2018 levels. And that weakness in platinum jewelry demand has to do with China, where there's been a long-term decline in platinum jewelry demand, which was further compounded and weighed down by weak domestic economic conditions in the country during 2019. We did see platinum jewelry demand grow in the United States as well as India. However, those gains were insufficient to offset the losses in the Chinese market, which is significantly larger than both the US as well as Indian market. Now, the discretionary nature of platinum jewelry demand, we expect, will hurt demand from the sector sharply during 2020, alongside demand from other sectors as well. Now, we did see an uptick in Chinese market activity during March and April, as fabricators were rebuilding stocks in response to the lifting of lockdowns and platinum prices at multi-year lows during that period. But we don't expect this demand to last in a sustained way over the course of 2020 because we don't see strengthening in platinum fabrication demand for the remainder of this year. We think that global platinum fabrication demand will decline, and we expect it to fall across sectors to about 6 million ounces this year. And if this weakness does materialize as expected, then this would be the lowest level of demand that we've seen for platinum since 1999. So commercial vehicles are an important component of platinum fabrication demand. And while demand for these vehicles was positive in all developed markets during 2019, as you can see in the chart on the left-hand side, the demand growth in these markets slowed as the year progressed. You had the trade dispute between the US and various trading partners, which threatened to throw the global economy into a recession. So you saw business sentiment soften, and along with that, you saw a declining growth of demand for commercial vehicles in these developed markets. And while demand for commercial vehicles softened in developed markets, they outright declined in the Chinese and Indian market during 2019. Now, not surprisingly, year-to-date commercial vehicle demand is negative across markets uh, as of 2020, as of April 2020. And demand from this source can be expected to remain negative through this year. Business sentiment should not be expected to pick up soon, given the various risks that we see in the global economy, ranging from the pandemic. You also have the US elections later in the year, you have Brexit. So we have a lot of factors we think that would hurt business sentiment and could be expected to weigh heavily on commercial vehicle demand. And while there's been large fiscal and monetary stimulus by various governments around the world, which should help to blunt the negative impact of these risks, businesses are unlikely, in our opinion, to loosen their purse strings and start spending on investments unless they feel more confident about the future economic prospects. So this will be a major headwind to platinum demand, given the importance of commercial vehicles in the sector this year. Another factor that we've been seeing, which has been weighing on platinum fabrication demand, has been the loss in market share of diesel passenger vehicles in both Europe as well as India, which are the two largest diesel passenger vehicle markets. Market share for these diesel vehicles at the end of 2019 were at the lowest level since the late 1990s in both Europe as well as India. And while we think that this trend is expected to continue, we think that the rate of decline should be expected to slow as we move forward. Now, most of the market share that's being lost by diesel passenger vehicles in Europe is being picked up by gasoline vehicles. And some of it that is being lost is being picked up by alternative propulsion technologies, in particular battery electric vehicles. The shift that we're seeing to gasoline engine vehicles is negative for platinum demand, given the current composition that we have for these catalysts that are fitted on gasoline engines. And then the shift to battery electric vehicles is overall negative for PGM demand. So what you're looking at here is the platinum to palladium price ratio, and platinum's value, as you can see in this chart, fell to around half of that of palladium during 2019 and has been lingering around that level since then. The sharp discount that we've seen in platinum prices to palladium has eventually and finally resulted in an announcement about reintroducing three-way catalysts, which will replace some of that palladium loaded in auto catalysts with platinum. So these three-way catalysts use a combination of platinum, palladium, and rhodium. These were the catalysts that were primarily used from around 1973 all the way into the 1990s, before platinum was to a large extent substituted with palladium in gasoline fuel cars, and then later also to a certain extent in diesel fuel cars. So the primary motivation to substitute platinum with palladium back then was the higher price of platinum relative to palladium. And over the years, palladium rhodium catalysts were optimized to meet ever-tightening emission standards, and the more stringent emission standards and the heavy penalties to auto manufacturers who failed them has prevented these OEMs from shifting from these tried and tested palladium rhodium catalysts back to the three-way catalyst. So that was one of the main reasons that there was this huge delay in announcing that shift. However, the large and persistent discount of platinum to palladium has now led these OEMs to think about reintroducing these three-way catalysts. And the increased use of such catalysts, we believe, will help to boost platinum demand into the future, but this would still take a couple of years to start having any kind of meaningful impact on the fabrication demand. So with that, let's talk about alternate auto propulsion technologies, by which we are referring to all non-internal combustion engine auto technologies. At present, the battery electric vehicle is the front runner among the various alternative auto technologies. This is a negative for not only platinum demand, but for all PGM demand, because these vehicles don't need auto catalysts. The demand for these vehicles has been growing strongly in recent years, as can be seen in the chart on the left-hand side. But these vehicles still account for a very small market share. The battery electric vehicles accounted for around 2.5% of passenger light-duty vehicle sales in 2019, and this share is expected to continue rising in coming years as governments continue to work towards decarbonizing their economies. Market share of these vehicles is expected to continue rising this year, even as total sales of these vehicles are expected to decline. So some governments are providing incentives to consumers to support their domestic auto markets, and many of these incentives that they're providing are focused on these lower emission technologies, which should help to boost the market share of these vehicles. So the increase in demand of these vehicles is not all bad for the demand of PGMs from the auto sector, with fuel cells and plug-in hybrids still requiring some volumes of PGMs. The market share for these vehicles is small though than compared to the battery electric vehicles, which also is small. But with plug-in hybrid electric vehicles, they accounted for only about 0.9% of passenger light-duty vehicle sales in 2019. And for fuel cells, it was even smaller. There was only a total of 7,500 such cars that were sold in 2019. So their market share is minuscule. So let's talk a little bit about fuel cells. We have 6 fuel cell technologies in use, of which only 3 use PGMs. So you have the phosphoric acid fuel cell, the direct methanol fuel cell, and the proton exchange membrane fuel cell. These are the 3 that use PGMs. And the most important of these for platinum demand is the proton exchange membrane fuel cell, which is used in the transportation sector. So as you can see in the chart on the right-hand side, transportation accounts for the vast majority of the megawatts that are produced by application. Now, there are 3 primary factors that affect the use of platinum in fuel cells. The first is the technology being used. As I mentioned, only 3 of the 6 technologies use platinum. The second is the level of thrifting and substitution. So there's a great deal of focus on reducing the amount of platinum being loaded in fuel cells from a cost reduction point of view. It's estimated that around 10 ounces of platinum are used per megawatt of power output, which is down around 90% from where it was a decade ago. And research is now being done to reduce this further by around 70 to 80% into the future. Additionally, some work is also being done to completely eliminate platinum from fuel cells. And while such fuel cells exist, they're not commercially viable at this time because they lack the stability as well as efficiency of platinum-based fuel cells. And then the third factor that affects the amount of platinum demand from the sector is the final demand for fuel cells. So that's basically the level of adoption for fuel cell electric vehicles, which will be an important factor in driving the amount of platinum demand. And as I mentioned, that there were only about 7,500 vehicles sold in all of 2019. So it's still a very, very small market. So what you're looking at here is a chart which compares different auto propulsion technologies. And we've used the internal combustion engine as a baseline and compared fuel cell electric vehicles, battery electric vehicles, and plug-in hybrid electric vehicles to the internal combustion engine. So there are 2 key disadvantages for fuel cells here. The first is that it has the highest total cost of ownership compared to all other technologies. That's because it has the most expensive technology and the most expensive fuel. The second disadvantage for fuel cells is that it has the least developed refueling infrastructure relative to other technologies. So in total, you have about 430 refueling stations around the world, and about 110 or 115 of those are in Japan. So there clearly isn't enough infrastructure at this point. So we think that if and when the fuel cell FCEV sector is able to overcome these 2 critical limitations, that's when we think that they would have some advantage or some scope for growing in numbers. You know, the fuel cell electric vehicles have several characteristics that put them on par or even ahead of other auto technologies, as we can see in this table. So everything that's in green basically puts them ahead of all of the other technologies. But these positives that we're seeing right now are secondary with regards to final consumers, with the final consumers primarily focused at this point on the total cost of ownership, the ability to refuel quickly, the availability of that infrastructure. And so we think that once these disadvantages are taken care of, fuel cells do have a future, but there's still a long path ahead for them. And it also should be noted that all technologies, even internal combustion engines, are being improved upon. So this will, in general, raise the bar for adopting any of the technologies, and it probably will eventually boil down to the total cost of ownership, which means making the technology cheaper, making the availability of fuel, and making the fuel available as well as making it cheaply available to final consumers. So with that, let's shift gears to platinum investment demand. The investor interest in platinum actually rose during 2019. Investor interest was driven by the deep discount of platinum's price, both relative to its own historic price as well as relative to palladium. In 2019, the market surplus, which is the metal available to the market, stood at about 250,000 ounces. And ETFs alone were net buyers of over 920,000 ounces, so about 3.7 times the annual surplus during 2019. Despite this, we saw platinum prices remain soft. And while there has been an increase in investor interest, which was especially evident in 2019, it could take some time for this investor interest to translate into higher platinum prices. And this is primarily because of the number of years in which the market has been in surplus with limited interest from investors. So this suggests that a lot of the metal that was not used by fabricators or absorbed by investors has been held by market makers who are more willing to sell or who are more willing sellers at whatever the current market price is. While investors are showing interest in the metal, it could be a few years until this excess metal that has accumulated over the years is taken in by investors, and it creates some kind of tightness in the market. And we think that we do expect this to happen because we do see a change in market fundamentals in the medium to long term, specifically for platinum, where we see a reduction in supply as well as some gains in fabrication demand. So investor interest in platinum was fairly broad-based in 2019. Platinum held by ETFs rose to a record high 3.3 million ounces in 2019, with investors absorbing a record volume of metal during the year. Investors remained net buyers of the metal during the first 2 months of 2020. Pandemic-related risk-off sentiment resulted in some net reduction, about 500,000 ounces, during March and April. However, investors were seen coming back and adding metal during May, but not sufficiently to offset that loss during the March and April period when there was a lot of market panic. Demand for platinum coins has been on a rising trajectory as well. Demand for these products is nowhere near what it used to be in the 1990s. And at the end of 2019, demand for these coins stood at about 81,500 ounces, which was the highest level of demand since 1999, when it was at 120,000 ounces. So US Mint Platinum Eagle coins have been strong during the first 5 months of this year, with investors absorbing about 56,500 ounces during this period, which is higher than the total of 40,000 ounces that was bought by investors during 2019. So this demand that we're seeing in US Mint Platinum coins, and we're hearing similar stories for platinum coins from other mints as well. So this demand, along with the net additions of ETF holdings in January, February, and May, suggests that investors still remain optimistic on platinum's medium to long-term fundamentals, which is to a great extent in line with what we're thinking as well. So what you're looking at here is the net long positions held by institutional investors on the NYMEX, and these positions rose to record high levels in 2019. The gains last year were driven primarily by a reduction in gross short positions, with gross long positions really rising aggressively and strongly only towards the end of the year. Now, net long positions remained at elevated levels during the initial months of this year, but with the pandemic, the net long positions were knocked down sharply along with all other markets. There has been some recovery in these positions in recent weeks, which is a trend which is similar to what we've been seeing in other sectors or parts of platinum investment demand. So with that, we'll move on to palladium. So total palladium supply rose to a record 9.8 million ounces in 2019, which was an increase driven by a combination of higher mine supply as well as secondary supply. Mine production rose for the third year in 2019, reaching 7.3 million ounces, and was driven primarily by gains in mine production from Russia as well as South Africa. A South African palladium mine output rose at a stronger pace than its platinum output. And while the difference was pretty stark in 2019, with South African palladium production rising 1.5% in 2019 versus a 0.2% gain in platinum output, this trend of more palladium production out of South Africa, or stronger growth in palladium production out of South Africa, has been in place for a few years. So South African output, palladium output, has been rising at about a 1.8% compound annual growth rate between 2016 and 2019, which compares to a 1.3% CAGR for platinum during that same period. And the primary reason for this is the depletion of that platinum-rich Merensky ore body and the increased focus of South African miners on mining palladium-rich ore. Something we discussed earlier in the presentation. Now, palladium secondary supply reached record levels as well. It was up to about 2.5 million ounces during 2019. This source of supply has been in a rising trajectory for several years now, supported by the high price of the metal and the increased use of the metal in autocatalysts since 2000. So what's been working against platinum secondary supply has actually been helping or increasing the amount of palladium secondary supply. There have been some technical difficulties in recovering palladium from autocatalysts in recent years because of the way the autocatalysts are being built and the way these metals are being coated onto the autocatalyst. So this has acted as a bit of a headwind, but not a sufficient headwind to result in a reduction, but more of creating bottlenecks in the supply chain, which also helps to explain to a certain extent that increase in palladium prices that we've been seeing in recent years. So we expect that coronavirus related disruptions will push total palladium supply down this year to about 8.9 million ounces, which is a decline of about 9.6% from 2018. And while this is a strong decline, it is a less strong decline than that being experienced in platinum and rhodium. And that's because palladium has a much more diversified source of mine supply compared to platinum and rhodium, which is primarily mined, and a vast majority of the mine supply comes out of South Africa, which has been particularly hit by this by the coronavirus related disruptions that we've been seeing. Scrap supply we expect will also decline in 2020. Again, we expect it primarily to be a result of the disruptions caused by the coronavirus, as well as a reduction in the final demand for vehicles, which will then also weigh on the amount of new autocatalysts coming into the market from scrap vehicles. So with that, let's move on to palladium fabrication demand. Palladium fabrication demand declined slightly in 2019 to about 9.9 million ounces, which was down 0.6% from 2018. But this was the first annual decline since 2009. So it's basically been rising or been almost continuously rising for 10 years. The decline in fabrication demand during 2019 was driven in large part by weakness in demand from both the auto sector as well as the electronic sector, which together account for around 80% of palladium fabrication demand. Now, palladium fabrication demand is forecast to continue declining this year, driven primarily by the negative impact of the pandemic. And total global fabrication demand we expect will drop to about 8.4 million ounces during the year, which would be a 15% decline from 2019 and would be the lowest level of palladium demand that we've seen since 2011, when it stood at about 8.14 million ounces. The decline in demand that we're expecting in 2020 is expected to be a broad-based decline, with not just focused on the auto sector or the electronic sector, but pretty much across all of its users. So one of the primary culprits of lower palladium demand during 2019 was the decline in passenger vehicle sales in the United States and China. The declines were much sharper in China compared to the US. And some of that lost demand in China was offset by stronger emission standards in the country. So tightening emission standards helped to offset some of the weakness in vehicle sales. Some of the lost sales in these two markets was also offset by an increase in gasoline cars in Europe. Since these cars still contain more palladium-rich auto catalysts, the increased market share of gasoline versus diesel in Europe was another factor that helped to offset some of that weakness in the US and Chinese markets. Yet another factor that helped to support palladium demand from the auto sector was the ongoing increase in the market share of light trucks in the US. So these larger vehicles, again, use more PGMs, holding all other factors equal. They consume more PGMs per catalyst. So this was again something that helped help palladium fabrication demand and helped offset to some degree the lost sales. And while there were all these factors collectively supportive of palladium fabrication demand, they weren't sufficiently supportive or positive to offset the weakness in sales during 2019. So that helps to explain to some extent the weakness in palladium fabrication demand last year, despite all of these other factors that helped to support palladium demand during the year. So what you're looking at here is the palladium market balance. And despite the decline in fabrication demand and the gain in total supply, the palladium market remained in a deficit during 2019. And the deficit definitely did narrow sharply, but that did not deter most investors' positive sentiment towards the palladium market. Even though the deficit shrank in 2019, the tight market conditions in the palladium market that have persisted now for years kept investors interested in palladium. So inventory holders have been feeding this deficit and have been willing to part with their holdings, but only at higher and higher prices. So you have seen some inventory liquidation to meet that fabrication demand, but it comes at higher prices. These investors offloading only at higher prices. Most inventory holders are still holding on to them. And at the same time, you are seeing some new investors adding to the palladium holdings and adding to that momentum in price gains that we've seen over the past few years. And this combination helps to explain the sharp run up in palladium prices during 2019 when the market's deficit was declining. Now the market's expected to flip to a surplus in 2020, and as long as investors remain interested in the market in the medium to long term, they would be willing to absorb the surplus. The surplus should create some headwinds for prices, but need not necessarily result in prices declining sharply. as long as investors continue to believe in the medium to long-term prospects of the market. So we don't necessarily see a sharp decline in prices, but we are not likely to see the kind of run-up that we've seen in palladium prices over the past few years. Prices are more likely to just stay at these elevated levels, at least over the course of this year. So one set of investors that have been selling into the price gains have been ETF investors. 2019 was the 6th consecutive year that holdings declined on a net basis. And these are one set of investors who have helped to offset or relieve some of that tightness in the palladium market. So with that, let's move on to rhodium, and start here with rhodium supply. So total rhodium supply rose slightly in 2019, but reached a record high of 1.01 million ounces in 2019, which was an increase of about 0.5% from 2018 levels, and was the 5th consecutive year that total supply for rhodium rose. Now, rhodium supply has been rising in recent years, primarily driven by gains in mine supply. South Africa, which accounts for around 80% of rhodium mine supply, has been behind this increase, with that increase focused on the UG2 ore, which has brought more rhodium into the market over the past few years. Rhodium scrap supply has also helped to increase rhodium scrap supply has basically helped to increase total supply, and that's been happening primarily because you have a lot of new auto catalysts coming into the market containing a significant amount of rhodium because of the tighter emission standards, which are particularly focused on NOx emissions, and rhodium is the only metal which can reduce those emissions. So the catalysts coming back into the market today contain a good amount of rhodium, and unlike platinum, you cannot easily substitute rhodium with any of the other PGMs, because it's the only one that does in fact help to absorb these NOx emissions. Like palladium, there have been certain technical difficulties in recovering the rhodium from the auto catalyst, and so that has been something that has created bottlenecks in the supply chain and can help to explain to a certain degree the sharp run up in prices that we've been seeing recently. This year we expect rhodium supply to decline along with what we're seeing in platinum and palladium as well. We expect a 12.5% decline in total rhodium supply to about 884,000 ounces this year. So with that, let's move on to rhodium fabrication demand, which declined in 2019 to about 1.06 million ounces, which was a 1.6% decline from 2018 levels. That decline in rhodium demand can largely be attributed to the overall decline in passenger vehicle demand and a slowdown in demand from commercial vehicles over the course of 2019. So while rhodium fabrication demand declined in 2019, it was still at the second highest level on record. The metal's heavy reliance on the auto sector, we believe, is expected to significantly hurt demand during 2020, with both passenger and commercial vehicle sales forecast to decline this year. Total demand we expect will slip to 870,000 ounces, which is an 18% decline from 2019 levels, and could be the lowest level of demand since 2009. So the rhodium market remained in a deficit for the 8th consecutive year during 2019, which was reflected in the price of the metal. Now that said, prices really began to rise only in late 2016, which means the deficits between 2012 and 2016 were being met by inventory liquidation. An exhaustion or near exhaustion of these inventories, coupled with increased investor interest as investors started to see the price of the metal go up, helps to explain further the sharp increase in prices in recent years. So we basically had the tight market conditions, the increase in prices, and then investors come in and tighten the market further. As a result of fabrication demand falling more sharply than supply this year, the market is expected to shift into a surplus. But after several years of deficits and the expectation of tight market conditions in the future, we don't really see rhodium prices decline sharply. We kind of see a similar fate for rhodium as we do for palladium, that it could struggle to rise the way it did in the first couple of months. So we don't necessarily see it fall back very quickly, at least this year, just given how tight the conditions are. So with that, I'll pass this back on to Jeff to speak about the minor PGMs.
Thank you, Rohit. Very good, very interesting. I will, before I talk briefly on the minor PGMs, remind you that there is a question area on the webinar bar that you can click on and you can type in questions. We already have a couple questions there, but since we're moving quickly toward the question section, I remind you that if you have questions, the way to ask them is by typing them in there. So there are three other metals: ruthenium, iridium, and osmium, and the six metals comprise the platinum group metals complex. They have similar physical and chemical properties, and they're clustered around each other in the periodic table. Ruthenium is used in a variety of applications. It's used in some catalytic converters, catalysts for chemical processes of a variety of different types of things. It's used in hard drives. Platinum ruthenium compound increases the thermal stability of hard drives and allows for both increased durability and increased storage capacity. People think, well, hard drives are largely gone because of the advent of solid state memory, but the reality is that all of this stuff on the internet and in the cloud primarily is still stored on hard drives, hard disk drives, and those hard disk drives use PGMs, including ruthenium. We've seen ruthenium prices rise sharply 2018, 2019, and they basically were pretty much stable. They weakened a little bit in 2019 and then began picking up again at the beginning of this year. But you have a relatively stable price, which reflects healthy demand across industrial applications and some new applications coming in. Iridium has really become a much bigger star, and we've seen the price rise to record prices and then rise even further to record prices over the last several years. We had a big round of increases in 2010 to 2012. Iridium is used in a variety of applications. Platinum iridium alloys are some of the toughest metals around. They used to be the toughest metal around. I'm not sure if they still are or not. And you see platinum iridium alloys used in a variety of applications. You also see iridium used in crucibles and other applications, making crystals that are used in electronics. And you see iridium used in crucibles and other componentry used in making LED lighting. In that period, 2010 to 2012, we saw a wave of increase in manufacturing capacity in LED lighting. That kind of backed off for a while, but over the last 2 or 3 years, we've seen another wave of capacity, manufacturing capacity in LED lighting, which is really becoming the go-to lighting technology. There are other industrial applications and high-tech electronic applications that are using iridium. And what you're finding is a number of smaller users needing this metal and basically having to draw on long-held inventories held by producers or refiners or fabricators. And the third metal, or the sixth metal, is osmium. And osmium, it has so many small uses, such small uses and such small demand that a lot of the companies that actually refine and sell osmium have ceased quoting osmium prices over the last year or two. The price has been relatively stable between $350 and $400 an ounce. It's used in some catalysts that are used to make various medicinal chemicals, including some steroids, and it's used in a few other applications. Many years ago, it was used in inks for fingerprinting, but that's been replaced by electronic imaging. It's a relatively stable metal. I'm going to open it up for questions now. And actually, what I'm going to do is go back to this chart that Rose showed you. I'm afraid that I actually have, bear with me for a second. I'll open it up to questions. The first question is, how do you explain the large platinum and palladium holdings by the state of Russia and the effects on the market of those? And what I wanted to do is talk about those. Metal that's held in inventories is metal at rest does not have an effect on prices. Metal that is in motion, either it's inventories that are being sold or it's metal that's being added to inventories, is metal that actually has an effect on prices. Over the period, really starting in the 50s, going through the 60s, 70s, 80s, the Soviet government produced much more palladium than the world needed and that it needed. And it added a lot of metal to its inventories over that period of time. Those inventories, the fact that it was adding that metal to the inventories helped stabilize the price of palladium during that period of time. When the Soviet Union collapsed in 1991, we entered a period of time where the post-Soviet authorities who were responsible for selling palladium were selling a lot of palladium, platinum, rhodium, diamonds from inventories. That period was most intense from 1993 through 1996. The Russian government came in and sort of changed things after 1996, and you saw a period of time that you had a shortage. If you, I'm pretty sure you're not seeing this chart, but if you go back to Rohit's chart on the palladium surplus deficit, we had a large increase to about 1 million ounces a year for about 3 years, 1993, 1994, 1995, and then about maybe 800,000 ounces in 1996, which represented these outsized inventory sales by the government. Once the hierarchy in the government discovered that that was happening, they changed the way they sold, and you entered a period of 4 years where you had large deficits in the palladium market because the Russian government was not selling undue amounts of metal, and in fact it was selling much less metal than it had been selling prior to 1993, rebuilding its inventories. And that led to the price of palladium going from $140 an ounce to $1,000 an ounce between 1996 and 2000, 2001. That period ended when the price of palladium got to $1,000 an ounce. And it started to come down, got to about $750 an ounce. The Russian government sold metal that it had, and you can see in this chart a big spike to over 3 million ounces of surplus. That was metal that had come into the market from Russian inventories. And the price of palladium basically went from 750 down to about 160 while that was being absorbed by the market. By 2002, 2003, it was absorbed by the market and we went back to more normal conditions. So to answer the question, now that I've given you all that ancient history, inventories held by the Russian government, and the government still holds some inventories in a couple different locations or a couple different institutions. Metal that's held in inventories really doesn't have necessarily a price effect. It only has an effect if they're being added to the inventories or if they're being sold from the inventories. We haven't seen a lot of Russian government inventories being sold in recent years, so they really haven't had a negative effect on prices. There are some private Russian inventories held by a fund that is related to Norilsk and Norilsk owners, and they have sold small amounts of palladium into the rise of prices in late 2019, early 2020, but it's had the effect of just tempering the upward pressure on palladium prices. The next question is, how do you explain the drop in investment demand to under 13-year lows for palladium versus platinum, while palladium is still at a high level? And I think that what you're looking at there is you're looking at a situation where inventory holders of palladium are not necessarily willing to sell their inventories at this point. In my introductory comments, I was talking about some long-term palladium inventory holders who are willing to hold this metal for long periods of time. And the attitude is, okay, I have these enormous profits in my palladium, but if I take those profits, where am I going to put it? Am I going to put it into an extremely volatile stock market? Am I going to put it into a very anemic and dangerous real estate market? How about bonds? Oh, you mean I'd have to actually pay somebody to buy bonds from them at this point? So the reality is that, and the investor psychology that's at play here is, I'm not going to sell my winners and invest in losers. Instead, I'm going to continue to hold my winners until such time as I feel that they probably really have peaked and could come down. So you have a risk that at some point, some of those record levels of inventories could start coming back into the market. But we simply haven't seen it over the last few years because palladium has offered a very compelling argument to continue holding palladium on the part of investors. And we've seen new investors coming into the market, whereas other metals and other investments haven't offered as compelling a reason to sell your palladium and move into those markets. The next question I will let Rohit handle is, what is the impact of COVID-19 on the sales of heavy-duty vehicles in 2020? I think you've talked a little bit about that, but you might want to review it again some more.
Sure. So what we've been seeing with sales so far this year is that they're down pretty much across markets. We have sales data through the end of April for most major markets for commercial vehicles. There was some improvement in China, but we don't see that being sustained. The declines in many of the other markets, we think, will deepen before they get any better. I don't think businesses are ready to make the investments necessary to push sales back into positive territory, at least this year. I think there's still a lot of uncertainty related to COVID, elections, Brexit. So you have a lot of risks which could keep business investment a little bit soft. So we think that those sales would go up, at least in the current year.
Okay. Rohit, you've got control of the presentation. You might want to go forward up to the rhodium surplus deficit. The next question, which I'll let you address, is how many total ounces of the rhodium market do you expect to be in surplus this year?
So this year we're expecting the rhodium market to be in a 18,000 ounce surplus. We expect rhodium fabrication demand essentially to decline more sharply than the declines that we're expecting in rhodium supply in the current year.
Okay. Those are the 4 questions we've gotten so far. If not sure if there are any other questions. No. Well, we have been talking for 75 minutes now, I guess, on PGMs, which for Rohit and I is a brief overview of the rhodium market. We hope that you have gained a lot of insights into some of the nuances in the supply and the demand, investment demand, and inventory trends that we're seeing in these markets. The PGM Yearbook, which is available for purchase at our website, cpmgroup.com, for $160 an ounce, is a 229-page report. So it obviously has a tremendous amount of information, both in table and chart form, but also in terms of the written analysis that's there, that would flesh out all of the topics that we've been discussing today. If there are no further questions, and I do not see any more questions, we will end this conversation, and we will be around for one-on-one conversations anytime anybody wants to reach out to us at info@cpmgroup.com. Otherwise, we'll see you next year when the cycle of gold, silver, and platinum yearbooks continue. Thank you and have a good day.